Hello, you're watching Dukascopy TV with me, Thomas Taplin. Now, if you're an investor and you're looking to invest your hard-earned cash in a particular country in the world, where would you go? Well, you could choose a country which often attracts investment like China or the US. But recently, the continent of Africa has been attracting more and more attention as an up-and-coming place to invest, with South Africa as the #1 spot, followed closely by Nigeria, according to Rand Merchant Bank. Well, on the line I have Nema Ramkhelawan-Bhama from RMB. Nema, welcome. Why has Rand Merchant Bank released a report to investors citing Africa and South Africa and Nigeria in particular as good places to invest when there have been riots, worker deaths, complaints of underpayment and other troubles affecting these regions?
Well, I think the first point to be made is that it is an annual report that was first launched in 2011. So this is, in fact, our third edition. And the indicators that we consider, the variables or the inputs used in our methodology, are long-term indicators. So if anything, they provide guidance to corporates, particularly venturing out into Africa, as to where the most viable long-term investment destinations are. That's not to say we discount any of the cyclical events that are occurring at the moment, particularly in North Africa, but we have taken that into consideration as part of this edition, which we can elaborate on, I think, further into the conversation. But as it were to happen, Nigeria and South Africa have always been the top two destinations in sub-Saharan Africa. In terms of our broader Africa ranking, Nigeria has actually leapfrogged Egypt into second place this year. Okay. And I think just to qualify why we say that, just the three indicators we look at is market growth, market size, and your operating environment. And that's just a broad-based indicator of your ease of doing business on the ground.
Okay, so if I was an investor looking at throwing my cash at Africa, as China has, for instance, what should I be looking for and where should I go?
Well, first and foremost, it depends on the type of investor. The methodology that we've applied is extremely broad-based, so we're trying to cater to all sectors. But for every sector, there's a different consideration. One factor, market growth, size, or the operating environment, might take priority or preference over another. But as an investor looking at Africa for the very first time, we look at theoretical evidence and compare it to actual FDI. So if we were to just plot our attractiveness rankings against FDI, the fit is almost perfect. So it's not only what theory suggests, it's actually what's happening on the ground. So just to come back to the point that you were making around where should I put my money? Well, if you were looking at the three components that we consider, South Africa comes out tops. It's still the mammoth in terms of market size and its presence on the continent, with around 600 billion in US dollars in terms of purchasing power. Yes, we do concede that market growth has been sluggish, forecasted at around 3.2% over the next 5 years. But if you were to just look at its operating environment, still moderately good as per our rankings. So even though South Africa has deteriorated ever so slightly, it's still a moderately good environment to operate in, only being surpassed by the likes of Mauritius and Botswana. Nigeria, on the other hand, #2, close on South Africa's heels. What's in good stead for Nigeria is definitely its market growth rate and also market size.
Now, one surprising thing for me about RMB's report was Egypt's investment ranking being behind Nigeria in third place. Why is Nigeria becoming increasingly more attractive as an investment opportunity in your eyes, and why is Egypt lagging behind?
Well, I think Egypt has been an attractive destination, and that was prior to the Arab Spring and the political upheaval. What we've done is actually run the methodology for the last 10 years, so we're able to discern a trend from that. And despite what's happening in Egypt at the moment, as I say, we don't discount the events, but what we do look at, we look through the noise and we try and see whether or not, after the political tensions have subsided, whether or not Egypt will still be a favorable investment destination. If we have to look at similar occurrences in other countries across the globe in the last 10 years, and we take Thailand as an example, because the political discord in Thailand is so similar to what was going on in Egypt, we find that perceptions around its operating environment in particular didn't change much. So if we have to apply the same assumption to Egypt, we won't necessarily see a massive deterioration in its operating environment, which, as I say, is a core assumption underlying our methodology. Market growth rates aren't expected to decline very much, but if they were, if we had to take a worst-case scenario, 3% as compared to the IMF's 5%, Egypt would probably drop down about 6 positions in our rankings. But I think the reason it's dropped down particularly this year is because Nigeria is still registering expeditious growth rates in excess of 6%, and its market size could well overtake South Africa in the next 2 years if they were to undertake their rebasing exercise in the next 6 months.
Finally, Africa is starting to make its mark in the investment world, no doubt. That's also according to RMB's advice to investors. But what, in your opinion, still needs to be improved on the continent to really attract investors in their droves?
Well, I think the core deficit in Africa is clearly around its infrastructure. Foreign direct investment is still very much a supporting factor underlying many projects, complementing government investment, which is in shortfall in many cases. And we need to see a concerted effort on the part of government and also private sector investment to improve the infrastructure deficit in order to facilitate more supply-side growth and more diverse supply-side growth. So not necessarily a reliance on your core or traditional resources. More than that, I think that we continue to see improvements, structural reforms, particularly in your socio-economic sphere, and that has to do with education, skills development. In order to bring about long-term productivity growth, there has to be an improvement in our labor, in our capital, as well as in technology throughout Africa if we are to compete with Southeast Asia in the next 10 years.
OK, thanks for joining me today, Nema. Keep watching Dukascopy TV interviews to get your fix on events affecting the financial markets this week. I'll see you next time. Goodbye.